Turning $500 into $5,000 is not about luck or shortcuts. It is about smart decisions, patience, and using the right strategies at the right time. Most beginners fail because they chase fast profits without understanding how money actually grows. The truth is, small capital can grow into something big when you use consistent methods and avoid emotional mistakes. Today we will talk about turn $500 into $5,000 fast smart investing strategy. So, before we start, make sure to leave a like and subscribe to my channel. 10. Start with a clear investment goal. Before you invest a single dollar, you need to know exactly what you are trying to achieve. Most beginners fail because they start investing without a clear goal, which leads to confusion and random decisions. A clear investment goal helps you stay focused and avoid emotional mistakes. It gives you direction, whether your target is short-term growth or long-term wealth building. When you know your goal, every decision becomes easier because you are not guessing, you are following a plan. Without a goal, even good investments can feel random, but with a goal, your money has a clear purpose and direction. 9. Focus on learning before investing more. One of the smartest decisions you can make as a beginner is to focus on learning before increasing your investment amount. Many people rush to invest more money without understanding how the market works, and that often leads to losses. Instead, take time to understand the basics of investing, how risks work, and how different strategies perform over time. Learning helps you make better decisions and reduces emotional mistakes. The more you understand, the more confident you become in managing your money. In investing, knowledge is just as important as capital, because smart decisions always protect and grow your money more effectively than fast action without understanding. 8. Track all your investments. Tracking your investments is one of the most important habits in building wealth. Many beginners invest money but never keep a record of where it goes, how it performs, or what returns they are getting. This leads to confusion and poor decision-making. When you track everything, you clearly see what is working and what is not. It helps you understand your progress and make smarter adjustments over time. Even simple tracking can improve your discipline and give you better control over your money. Successful investors always know where their money is and how it is performing. 7. Avoid quick-rich mindset. One of the biggest reasons beginners fail in investing is because they expect fast and unrealistic profits. The quick-rich mindset pushes people to take unnecessary risks, chase hype, and make emotional decisions. In reality, investing is a long-term process, not a shortcut to instant wealth. Real growth takes time, patience, and consistency. When you stop chasing fast money and focus on steady progress, your chances of success increase significantly. The goal is not to get rich overnight, but to build wealth step by step in a safe and sustainable way. 6. Avoid putting money in one place. Putting all your money into a single investment is very risky, especially for beginners. If that one investment fails, you can lose everything at once. That's why smart investors always spread their money across different options. This is called diversification. It reduces risk and protects your capital from sudden losses. By dividing your money into different investments, you create balance and stability in your portfolio. Even if one area performs poorly, others can still perform well and keep your overall progress steady. This simple strategy helps you grow more safely over time. 5. Study successful investors. One of the smartest ways to improve your investing results is to study people who have already succeeded. Successful investors follow clear strategies, stay disciplined, and avoid emotional decisions. By learning how they think and act, you can avoid common mistakes and understand what actually works in the long run. You don't need to copy them exactly, but you can learn their mindset, risk management, and patience. The goal is to understand patterns, how they grow wealth slowly, how they handle losses, and how they stay consistent even during market changes. Learning from others can save you time and help you make better decisions with your own money. 4. Focus on consistency over speed. Many beginners focus on how fast they can grow their money, but real success in investing comes from consistency, not speed. Trying to grow money quickly often leads to risky decisions and losses. Instead, steady and repeated actions over time create stronger results. When you stay consistent, even small investments can grow significantly through compounding. The key is to keep investing regularly, stay patient during slow periods, and avoid stopping just because results are not immediate. Over time, consistency builds a strong foundation that leads to long-term financial growth. 3. Use dollar-cost averaging method. Dollar-cost averaging is a simple and powerful investing method where you invest a fixed amount of money regularly, no matter what the market is doing. Instead of trying to guess the perfect time to invest, you spread your investments over time. This reduces risk because you are not putting all your money in at once. Sometimes prices will be high, sometimes low, but over time it balances out. This method helps remove emotional decisions and makes investing more disciplined and consistent. For beginners, it is one of the safest ways to build wealth gradually without stressing about market timing. 2. Avoid panic selling during drops. One of the biggest mistakes beginners make is selling their investments when prices suddenly drop. This is called panic selling, and it usually leads to losses that could have been avoided. Markets always move up and down, and short-term drops are completely normal. When you panic and sell too early, you turn a temporary decline into a real loss. Smart investors stay calm during these moments and focus on long-term results instead of short-term fear. Instead of reacting emotionally, it is better to stick to your plan and understand that drops are a natural part of the investing process. Patience during difficult moments is what helps protect and grow your money over time. 1. Think in months and years, not days. The most important mindset in investing is long-term thinking. Many beginners check prices daily and get stressed by small changes. But real investing success does not happen in days. It happens over months and years. When you focus too much on short-term movements, you are more likely to make emotional decisions that hurt your progress. Instead, you should think about where your money will be in the long run. Small daily changes don't matter as much as long-term growth trends. By shifting your mindset to long-term thinking, you give your investments time to grow properly and reduce unnecessary stress. This approach is what separates beginners from successful long-term investors. What do you think about our video? Let me know in the comments below. Before you go, leave a like and subscribe to my channel. Thanks for watching.